By the time a new crypto token finally hits a major exchange like Binance or Coinbase, the headlines are already flashing everywhere. But have you ever wondered how certain investors manage to secure their allocations months before that token ever sees the public light of day? It's this fascinating hidden side of the market, and today, we're going to figure out exactly how they pull it off. Welcome to This Explainer. Today, we're cracking open the insider's playbook to understand exactly how early crypto investing works. We're going to explore how folks buy into these new projects way before the masses. But listen, we are also keeping a super strict eye on the severe risks involved. This isn't about some guaranteed shortcut to getting rich. It's about understanding the mechanics of a really advanced, high-risk strategy. So, here's our roadmap for today. We'll cover what pre-market crypto actually is, the token life cycle, how to get in early, the appeal, the real risks involved, and finally, how to evaluate these opportunities safely. Let's kick things off with Section 1. What is pre-market crypto? Beating the exchange listing. In simple terms, this just means acquiring a stake in a crypto project's tokens long before they're ever listed on a public exchange. Moving to Section 2. The crypto token life cycle. From idea to market. Right, so to understand how this all works, you really have to understand the timeline. Everything starts with the idea and development phase. This is where the team is building the product, writing the white paper, and mapping out their roadmap. Next up is the private or crypto seed round. This is where early capital comes in from angel investors, VC funds, or strategic partners, usually at a massive discount. Then you'll often see a public or community sale, like a token pre-sale, where a wider group of early supporters can jump in. After that, we hit the TGE, which I'll explain in just a sec, and finally the exchange listing, where the token goes live for public trading and price discovery begins. Pre-market crypto investing, that simply means getting in at any of those earlier stages before it hits the open market. Let's pause for a second on TGE, or Token Generation Event. This is literal. It's the exact moment a token is officially created on the blockchain and distributed. Before the TGE happens, you don't actually have tokens. You're essentially just trading promises, points, or claims. So the big takeaway here is that pre-market investing is all about securing your spot before the specific event happens. All right, Section 3, how to get in early. Let's look at 4 main access points. So, how do regular investors actually bypass the waiting room? Well, there are 4 main ways you should know about. First up, launchpad platforms. These let smaller investors get in on early sales, but heads up, they usually make you hold their specific platform token or deal with some complicated tier system just to get an allocation. Second, pre-market trading platforms. These are wild because they actually let you trade a project's expected future token using claims or points before the token even exists on-chain. Third, community or public sale rounds. Sometimes projects open up a slice of their supply before listing, often through an initial DEX offering. And finally, OTC, or over-the-counter deals. This is where big money investors buy allocations directly from early holders. But man, that carries way higher counterparty risk for sure. Moving on to Section 4, the appeal of pre-markets, the early bird advantage. Now, you might be asking, why jump through all these crazy hoops? Let's break down some practical math to show you the appeal. Imagine a project raises a seed round at a $10 million valuation. Early investors are buying in at that specific floor price. Let's say the project launches successfully and lists publicly at a $100 million valuation. For those early birds, their position just grew exponentially. They locked in their tokens when the project was valued at literally a tenth of its public debut price. That's the dream, right? But, and this is a massive, massive but, we have to remember that these exciting entry valuations are strictly paper gains. Paper gains absolutely do not equal realized profits. Seeing your portfolio values skyrocket on a screen is a completely different ballgame from actually being able to click sell and transfer that money into your bank account. And that brings us crashing into the harsh reality of this whole strategy. Section 5, the real risks involved, the catch to getting in early. Okay, the biggest, most immediate risk here is illiquidity. Illiquidity basically means your pre-market tokens or claims are totally locked up. You cannot resell them or convert them to cash until that official listing happens. Your money could be completely stuck for months with zero ability to cash out, no matter what the rest of the market is doing. If you suddenly need that capital for an emergency, you are completely out of luck. You also have to aggressively weigh the hype against reality here. Marketing in this space, it's going to scream at you about guaranteed returns, or they'll try to trigger major FOMO by saying time is running out. But the realities you're actually dealing with include total project failure, where a token literally never launches. You're dealing with highly sophisticated scams, phishing schemes, and a constantly shifting landscape of regulatory uncertainty around securities laws.
And what's truly brutal is how the mechanics actually lock you in. Even if you find a perfectly legitimate project, you're going to face lockup periods and vesting schedules. That means early investors don't just get handed all their tokens on day one, they're trickled out slowly over time. Add that to valuation uncertainty since there's no public market price yet, plus the fact that there is absolutely zero guarantee the project will ever successfully list, and yeah, you can see how heavily the deck is stacked against you.
Section 6. Evaluating opportunities safely. Due diligence. So, if the risks are that crazy, how do careful investors actually evaluate these things without getting wrecked? It all comes down to rigorous due diligence. Here's your checklist. First, dig into the team's track record. Are they anonymous, or do they actually have a history of shipping successful products? Second, read the actual white paper to understand the real use case. You gotta look past the shiny mark of it. Third, verify if the project has actual real-world backers like known VC funds. Fourth, scrutinize the tokenomics. What's the total supply, how is it allocated, and what does that vesting schedule actually look like? And lastly, always verify the security and reputation of whatever platform is facilitating the deal. Honestly, if you only take one golden rule away for evaluating a token presale, let it be this. Be exceptionally cautious of any offer promising guaranteed returns or using high-pressure urgency tactics. If someone is sliding into your DMs saying there are only 2 spots left or swearing you'll 10x your money by Friday, run. Run the other way. It is almost definitely a scam. I want to turn this over to you for a second. Have you ever come across a pre-market crypto opportunity out in the wild? Or maybe you've even participated in one? Let us know your experiences down in the comments. It's always great to hear what you're seeing out there. And hey, if you enjoy breaking down these complex crypto concepts into clear visual explainers, make sure you hit subscribe so you don't miss the next one. One final firm reminder before we wrap up. This explainer is strictly for educational purposes, guys. It is not financial advice. Pre-market crypto investing carries a remarkably high risk of total loss, so you absolutely must do your own independent research. But it leaves us with a pretty compelling question to chew on. Are the massive potential rewards of getting in early really worth navigating a market that's just full of hidden traps? Or is waiting for the public exchange the only truly safe bet? Stay curious, stay cautious, and thanks so much for learning with us today.